Hi guys, so today we'll be covering chapter 18, which is reports on the audited financial statements. So if you recall, we looked at this little chart on the major phases of the audit back in the very end of chapter 1. So we're returning to this chart to kind of remind ourselves where we are in the audit process, because for the most part in this course, we will be going through linearly. So we will start with the planning of the audit, right? Like, do I want to accept this client? Then I plan the audit, then I test the internal controls, then I test the accounts, and then I finish the audit. And the very last step is actually to issue my auditor's report. So today we're deviating from our linear trip through this course to talk about the audit reports first. And the reason why we do that is because in all these other chapters, it kind of talks about and references the different types of audit reports. So it's kind of awkward if you don't actually know what they are till you get to chapter 18. So it's much easier to talk about them up front. And then as we go through the chapters, if we say, you know, if XYZ happens, you give the client a disclaimer or a qualified opinion, you'll know what those things are. Any discussion of, you know, to help you guys understand the audit report and the different types needs to start with a definition of materiality. We have these definitions coming to us that basically say that information is material if omitting it or misstating it could influence decisions made by financial statement users on the basis of that information. And so slightly simpler terms, you could put it this way, saying materiality is the amount by which financial statements can be misstated before it starts to affect the judgment of people. Again, this is quite abstract, so let's talk about it in the context of a real example. Okay, so here we are on sec.gov. For those of you who do not know, sec.gov, this is where all our public companies or registrants, SEC registrants, are required to go file their financial statements. To find an example, we'll go here. We'll go search for company filings, search by our ticker symbol. So if we want to stick with Apple, all right, so this takes us to all of Apple's filings with SEC. As you can see, there's a whole page of them, just doesn't even go back past September 13, and you can go to the next. And I think believe these go back to 1994. So let's take a look at Apple's 10K. Go to item 8, which is the financial statements. So now we have Apple's income statement and balance sheet. These numbers are in millions. Okay, so keep that in mind. And we see that as of September 26, 2020, Apple had 38 billion in cash. All right. And we see like the millions are just barely making it onto the screen. So we have 38 million in cash, and that is a number that you as an investor, you would rely upon that number and all these other numbers, right, to make decisions about things based on these financial statements. So those decisions could be to buy or sell shares of Apple stock. If you're a bank, you're considering giving a loan to Apple, you would look at this balance sheet to see like, okay, what collateral did they have for my loan? What do their cash flows look like, etc. So people are relying on these financial statements to make real decisions, which was part of that materiality definition. And the question is, how much does this number need to be off by before it starts impacting people's decisions? So I think if we look here, 38 billion, right? If that number were off by 10 million plus or minus. So if it's 38,026 or if it's 38,006, that's probably not going to change anybody's decision making, right? Based on this set of financial statements. So it seems like for Apple, this $10 million threshold probably is immaterial for Apple, right? It probably doesn't matter one way or another if things are plus or minus 10 million. However, let's think about $1 billion now. If this were off by $1 billion, if this should be 39 or 37, that could potentially start impacting people's decisions. Even that, I think some people might argue, but it could feasibly start to impact ratios people are calculating, etc. So it is possible, right? If this is $1 billion off, that's a problem. So really what an auditor does is they try to come up with a materiality threshold that is between the point where you don't care and it doesn't matter and it's not going to influence decisions, and you need to figure out that point where it starts to impact decisions, right? Because if something is off, if something is incorrect in the financial statements, we want to make sure it's below that level where stuff will start to influence people's decisions. Okay, so basically that level is materiality, right? If you're above it, if an error is bigger than materiality, there's a problem, because people can't really rely on the financial statements. But errors below that, right, don't really matter. Even if it is $1 million, $1, $2, $3, $4 million, right? I mean, it sounds like a lot of money to us, but relative to a company of this size, it's kind of their pocket change, right? So let's go back to our slides now. Hopefully this definition of materiality makes more sense now that we've looked at it with a slightly more concrete example. Now, there are really two types of materiality that an auditor has to think about: quantitative materiality and qualitative materiality. So quantitative materiality is all about, let's put a number on this to figure out stuff above the number is material, stuff below the number is immaterial. We usually calculate our materiality threshold based on various things: 3 to 5% of net income. This is the most common materiality threshold that we could use. We'll talk more in chapter 3 because chapter 3 has a whole section on materiality. So we'll talk more then about why you deviate from this and go to some of these other benchmarks for materiality, like equity or total assets. But it's kind of irrelevant for now and for this discussion today. Okay, so an example here is if a company had $8 million in pre-tax net income and you decide to use 5% of pre-tax net income as your materiality threshold, then that would mean $400,000 was the materiality threshold, meaning misstatements above 400K are a problem. We think they would impact decisions of financial statement users. And so those would need to be fixed, or at least enough of the misstatements need to be fixed to bring it below that 400K threshold, because most companies have, misstatements in several different accounts that we find when we're doing the audit. If your misstatements aggregate to below 400K, you're okay. You actually don't, we can find errors all day long, but if they're aggregating to below 400K, they effectively don't matter for the purposes of the audit because we believe they won't impact people's decisions one way or another. So now let's talk about qualitative materiality. It's any number, whether quantitatively material or not, that would impact users of the financial statements. So then it would be material, right? So even if it's below that 400K threshold, if for some reason qualitatively we think it's going to affect users' decisions, then we worry about it too. So we have an example here, which is this company, right? We're continuing with our prior slide. So this company has 8 million in pre-tax net income. They have 1 million shares outstanding. So their EPS, as they want to put out in their financial statements, is $8 a share. Their aggregate misstatement is $300,000 in overstatements. So that's the impact to net income. And we know this is below we said materiality is 400K, and we know 300K is less than 400K. So it seems like we're okay here, right? Well, let's talk for a minute about this. So what's the real EPS here? So we know their stated EPS is $8 a share, right? And we know that we believe that that's overstated by 300K. So we think their real EPS is really around 7.7 million or $7.70 per share. Okay. Now, meanwhile, we look at things like analyst forecasts and other benchmarks. And we note that the analyst forecast for this year was $7.80 a share, right? So basically, by misstating the 300K, they are now above the analyst threshold, right? Because they're $8 a share. Whereas if, I'm going to say versus $8 a share, they're good. Because companies always want to come in at or over the analyst forecast. Why is that? It's because if you miss your analyst forecast, people take that as a negative signal about the company, and they'll usually start to sell your stock. You'll see a little stock price dip if you miss an analyst forecast, and nobody likes that. So we want to always meet or beat our analyst forecasts as management. However, if they actually stated what we as the auditors believe is the real EPS, they would have been below the forecast. This is bad, frowny face. So, and this means they would have taken like kind of a stock price hit. So this is what this sort of qualitative characteristic we need to consider. Because yeah, technically 300K shouldn't matter one way or another. But if it's the difference between you not hitting your analyst forecast and being able to meet or beat your analyst forecast, then yeah, that is a meaningful difference because it will impact people's decisions. So not a good thing in this case. And we would want them to fix it ideally. This is again why we as auditors need to think about quantitative and qualitative materiality. So before we get into the nitty-gritty meat of this chapter, let's really briefly talk about the different types of opinions that an auditor could issue. Number one that they can issue is an unqualified opinion. This is the opinion everybody wants because it is basically the clean or good opinion. And if you read through this, what it says is an unqualified opinion is basically saying an auditor is saying we can provide reasonable assurance that these financial statements are fairly stated. Remember, reasonable assurance implies that materiality, right? Things are not misstated by more than materiality. Remember, absolute assurance would mean I'm 100% correct. Unqualified, auditors giving you reasonable assurance that these financial statements are correct and any errors would be beneath materiality. Now, we also have unqualified with explanatory language. So in these cases, the financial statements are still good, they're still correct. However, there's some issue that we decided we wanted to point out in an additional paragraph or with extra language. We'll talk about some examples of that later, so I'm going to breeze past it for now. The next major type of opinion is qualified or an except for opinion. So this opinion is saying, okay, the financial statements are materially correct except for this one thing, which is wrong or incorrect by a material amount. Basically, this could be a single account is off, right? Like not the whole financial statements are off. Right? For the most part, they're okay, except for this one thing. Adverse is the bad opinion. And this is when an auditor is saying, hey, these financial statements, you cannot rely on them. They are not presented fairly in accordance with GAAP. So if we have multiple accounts that are off by more than materiality, adverse opinion is what we would be going for. And last but not least is the disclaimer opinion. So this is basically saying we cannot give an opinion one way or another. We don't know if it's good. It might be good, but we don't know. It might be bad, but we don't know. Basically, we can't give you an opinion. And this can happen for a few different reasons, which we'll discuss, but it could be auditors not independent. So if they're not independent or objective, they shouldn't be issuing an opinion. It could be because information that is needed to validate the accounts does not exist. We'll talk about more reasons why later.